When you deposit your paycheck, it's easy to picture that money sitting inside a steel-reinforced vault, locked safely away and waiting for the day you need it. But that vault is mostly empty. Under a system called fractional reserve banking, institutions only keep a tiny slice of their customers' deposits on hand. The rest is immediately lent out to someone else, who deposits it in another bank, where it gets lent out again. The bank effectively creates new money simply by issuing debt. Historically, banks had to keep at least a fraction of those deposits in reserve, but in March 2020, the Federal Reserve dropped that requirement to exactly zero. Today, there is no mandate for commercial banks to hold any physical reserves against your deposits. We've built a money supply that runs on the constant creation of new liabilities. It's an engine powered by systemic debt, functioning only as long as borrowers keep coming through the door. The blueprint for this debt engine was drafted in secret. In 1910, Wall Street elites, including prominent bankers like Paul Warburg, met on Jekyll Island to design a centralized banking system for the United States. What they built is a unique hybrid. While its headquarters at the Eccles Building in Washington looks like a standard federal agency, the Federal Reserve is highly independent. Its monetary policy decisions don't require presidential approval, and it receives absolutely zero funding appropriated by Congress. The mechanics get stranger at the regional level. The 12 regional Federal Reserve banks are not government-owned. They are owned by private commercial banks. By law, these private banks must hold stock in their regional Fed, which earns them a guaranteed dividend every year. This structure allows the Fed to set the cost of money for the public, while distributing guaranteed profits to its private shareholders, all without a single dollar of congressional oversight or funding. When you give a central bank the power to control the cost of money, you also give it the mathematical power to decide who gets wealthy. This flow of funds chart tracks U.S. net worth, reaching $172.7 trillion by 2024. But splitting this growth by asset class reveals a stark reality. The explosion is overwhelmingly driven by corporate equity and real estate, while average savings and wage growth remain completely flat. By aggressively expanding the money supply and keeping interest rates low, the central bank inflates the value of financial assets. This mathematically favors the investors who already own those assets, mechanically widening the wealth gap with every new dollar created. This financial leverage extends to every corner of the earth. The global economy runs on a dollar standard, meaning international trade and foreign debt are settled almost entirely in U.S. currency. A quick audit of the Fed's balance sheet reveals just how much leverage this provides. The Federal Reserve holds over $3.5 trillion in marketable securities in custody, specifically for foreign official and international accounts. To keep this global machine running, the Fed uses tools called central bank liquidity swaps. These act as an invisible architecture, quietly injecting dollars into foreign central banks, like the European Central Bank or the Swiss National Bank, whenever overseas markets face a dollar shortage. Through these mechanisms, the Fed acts as the ultimate centralized choke point for international trade. It is, for all practical purposes, the unelected central bank of the world. Yet despite this immense centralized control, the system is highly fragile. From the bank runs of 1907 to the crash of 1929 and the catastrophic meltdown in 2008, the financial sector has repeatedly proven it cannot manage its own risk. When the housing bubble burst in 2008, Federal Reserve Chairman Ben Bernanke initiated massive market interventions. The Fed launched the primary dealer credit facility to lend cash directly to investment firms and purchased over $1 trillion in toxic mortgage-backed securities to clear bad bets off bank ledgers. This created a condition known as moral hazard. When the Fed authorized an $85 billion loan to stave off the bankruptcy of the insurance giant AIG, it sent a clear signal. Megacorporations can take extreme risks because the central bank will print billions to save them if those bets fail. We have built a global casino with a severe structural paradox. Corporate profits remain strictly privatized, but catastrophic losses are systematically socialized to the public. Today, that socialization of loss happens digitally. Physical cash is increasingly obsolete, making up only a tiny fraction of the actual money supply. Instead, the architecture relies on digital ledgers, systems like FedWire for massive wholesale transfers and FedNow for instant retail payments. allow the central bank to manage and move trillions in reserve balances entirely outside the public's physical grasp. This chart visualizes the ultimate cost of abandoning the gold standard for a purely fiat system. Without physical constraints, the Federal Reserve exploded its total assets, surpassing $7 trillion. As one advisor noted, inflation acts like a cancer. By creating trillions of digital dollars, every existing dollar loses its purchasing power. The dilution of your paycheck is the mathematical consequence of a continually expanding fiat system. Every new digital dollar created on that ledger systematically erodes the purchasing power of the ones already in your pocket. The public is beginning to push back against this lack of transparency. For decades, congressional hearings provided the theater of political oversight, but rarely delivered actual accountability. It took a massive lawsuit by Bloomberg LP, fighting through appeals all the way to the U.S. Supreme Court, just to force the Fed to reveal the identities of the specific firms it bailed out during the 2008 crisis. Resistance to central banking has deep academic roots. Nobel laureate Milton Friedman famously advocated for abolishing the Fed entirely, pointing to its failure to provide liquidity to small banks during the crash of 1929, which actively contributed to the Great Depression. Today, that academic critique has evolved into a populist movement. Figures like former Congressman Ron Paul have built massive coalitions demanding a full audit of the Fed's activities and a return to hard money standards. The Federal Reserve's influence depends on its technical density. When you map the balance sheet and trace the flow of bailouts, the structural complexity that protects its power begins to give way to simple arithmetic.